You're syncing up and tuning in to the Lending Link podcast, powered by GDS Link, where the modern day lender can dive deeper into the future of data, decisioning, and credit risk solutions. Welcome to the show, everyone. I'm your host, Rich Alterman, and today we're syncing up with Brian Clegg, Senior Lender Solutions Manager at Blackbook, where he has worked for more than 11 years. In his role at Blackbook, Brian consults with auto finance lenders across the U.S. and Canada on how to best leverage Blackbook's vast data sets to reduce risk and increase profitability throughout the loan lifecycle. Brian was recognized as a 2018 Auto Remarketer 40 Under 40 honoree. The Blackbook family of vehicle appraisal guides in the United States, which provides vehicle pricing data, is published by National Auto Research, a division of Hearst Communications. New and used car dealers, lenders, manufacturers, fleet remarketers, and government agencies have used Blackbook since 1955. Blackbook provides value for both new and used vehicles, including cars, light trucks, and collectible vehicles produced since 1946, and motorcycles, ATVs, snowmobiles, personal watercraft, and heavy-duty commercial trucks and trailers. Other products include vehicle identification number or VIN decoding software, projected residual values, inventory management tools, and lead generation applications. In this episode, Brian and I will touch on key trends impacting vehicle values, some key statistics on auto lending, potential impacts of shifting views towards car ownership, and so much more. But before we dive into the interview, please head over to our LinkedIn and Twitter pages at GDS Link, that's GDSLINK, and hit those like and follow buttons. If you have not done so already, please subscribe to our podcast on Apple Podcasts, Spotify, or wherever you prefer to listen to your podcast. All right, now let's get synced with GDS Link. Welcome, Brian. I hope you have a great week so far. Thanks for participating in our podcast. Where are you joining us from?
I'm joining today in the suburbs of Metro Atlanta, reporting live from my office and work remote a few days a week. But thank you for having me. It's an honor and a pleasure. And I'm looking forward to sharing information about Blackbook and the market trends that we're seeing.
Well, great. Well, thanks for joining again. So, Brian, you've been with Blackbook now for over 11 years. Can you please share a bit on your background before joining Blackbook? And what was the road that took you there, pun intended?
So, it was a kind of a curvy road getting to Blackbook. I started out right out of college, went to work for Wells Fargo as an entry-level credit manager with a focus on consumer lending, which was unsecured loans, auto loans, real estate loans, then worked my way up into management and was there for 5 or 6 years and was really in the day-to-day operations of booking loans and understanding the whole finance process. And then 2008, 2009-ish, you had the Great Recession. There was a merger with Wachovia and Wells Fargo, and part of the department I was in disappeared. And I went to the bank for a little while and went to look for a consulting job with Wells Fargo Home Mortgage. And the person I'd reported to previously at Wells Fargo was now at Blackbook. So I gave him a call and said, hey, we're getting deep in the interview process. I'd love for you to be a reference for this new position I'm applying for. And a few days later, he called me up and said, hey, Brian, I know looks like you're looking for something new. I don't want to take you away from it. But at that time, Blackbook was headquartered in Gainesville, Georgia. And he said, come up to Gainesville with an open mind. And that's where it all started.
Great. And here you are 11 years later. Obviously, it's been a good decision. Good decision. Yeah. So, thanks for sharing that. And, I always like to get a little personal before we dig into the business side of things. So, I understand that you enjoy coaching sports. What do you coach today?
Well, currently I'm not coaching. I'm taking a little break, but previously I coached multiple seasons of flag football and t-ball and soccer with my son. And now he's moved into full contact tackle football. And it's been really fun. So I'm kind of on the sidelines for now. We're going to see how it goes. And after this season, I may come back. But I'm just kind of feeling out the league and everything for right now. But it's been a lot of fun.
As you think about being a coach and coaching children, what are some of the life lessons you want them to take away from being in team sports?
I think it's, adversity, getting out there when it's hot. But what I tell my son is really just two things to focus on. It's one, do your best, and two, listen to your coach. If you're doing your best and you're listening to your coach, good things are going to happen for you. And one thing I really loved while coaching, we would have some kids that had different talent levels than others. And what I love is when all of a sudden they get it and they blossom and you see some of your less talented players just do great. And as a coach, is no better feeling in the world to see that. And it's just a ton of fun.
Thanks for sharing that. Okay, so let's get down to business. But before we start, I wanted to share some stats that I read the other day. Experian put out their state of the automotive finance market for Q1 2022 versus Q1 2023. And I just thought, some of these highlights were interesting. Number one, according to the recent report, the average car payment for new vehicles was a record high at $725 in the first quarter of 2023, an 11.5% increase from the first quarter of 2022. Wow, that's $725. Wow. The average car payment for leased vehicles increased at a comparable 11.2%. However, the increase in the average car payment for used vehicles was just 2.2%. Auto loan debt is the third largest debt category behind mortgages and student loans. Overall, Americans owe $1.56 trillion in auto loan debt, according to the Federal Reserve Bank of New York, accounting for 9.2% of American consumer debt. And then Americans are taking many years to pay back their auto loans. The average auto loan term now is 68.6 months for new cars, 67.4 months for used cars, and 35.3 months for leased vehicles, according to Experian. I also read, which was interesting, that 5 years ago, there were about a dozen models of new cars that sold for less than $20,000. In 2023, there was only one, the Spartan Mitsubishi Mirage hatchback, which accounted for about 5,300 of the 7.7 million new vehicles sold in the U.S. in the first half of 2023. Pretty interesting stats. I think about the last podcast I did with Kevin Moss, and we talked about some of the stats going on with the national debt, consumer debt, which continues to grow, as we all know. And most recently, of course, we heard that the federal guaranteed student loan program, which has been payments have been paused, are supposed to resume in September, October. Although I did see in the news last night that President Biden is looking for some new approach. But when you think about those high car payments, you think about the high rental payments, and now you think about the the student loan debt coming back in. It's hard to think through how people are going to really manage their way through those increased costs. So let's start off with having you provide a high-level overview of Black Book and the type of clients that you particularly focus on in your role with the company.
Oh, sure. So I know you mentioned earlier, Black Book has been around since the 1950s. Our core product, of course, is going to be vehicle values. And so we archive our data, what they were in the past, of course, what the vehicles are worth today, and then we forecast what the vehicles will be worth into the future. That's our core product, and we have over 500 data points per VIN number. So it's not just vehicle values. We have all kinds of specs on the vehicles. And then outside of that, we'll talk about later, there's other data sources that we're going to be putting out into the market that people will see. We're starting to license out some of our own internal data. But as far as my role, it's very unique, I would say. And it is a lot of fun. I work primarily with financial institutions, East Coast to West Coast. Probably say 85% of my time is spent with different financial institutions through different credit spectrums. I may have a phone call with a large bank and then hop off and I'm talking to a medium-sized credit union. Then I get on another call and I'm talking to a credit bureau. And then I'm talking to a loan origination system. That's what we call a value-added reseller of our data. That a lot of times, sometimes they utilize, of course, the GDS link interface that's currently available. And then I may go from there and talk to an accounting firm or an investment group in New York City or an insurance company or sometimes even a state agency that does things like add valorem tax on your vehicles. So it's a very diverse role, and I'm working with anything through looking through our data and explaining what's available, how it's worked, methodologies, and how it's derived and how we deliver that, to contract negotiation and just everyday service that our clients need. So I'm kind of the main point for most of our customers. And then we have an automotive side that focuses more on dealer groups and DMS software and lead gen companies with the automotive space. But that's a pretty high level view of what my role looks like.
Sounds real interesting and diverse. So I know it's been a while, but back in 2014, Black Book became more aggressive on the analytics side of its business, hiring its first EVP of analytics, a friend of both of ours, Neil Goyle, who's now president of CoreServe. Can you share what was the catalyst behind this decision and maybe some of the key benefits it's brought to both Black Book and your customers?
A lot of this kind of derived, probably say 2009, when the Great Recession hit. And what we saw was just a huge influx of financial institutions coming to Black Book. So when a lot of the lenders were burned on deals, course, they wanted to blame it on the vehicle values that were used. So we saw just a huge spike in interest, where a lot of times we were more focused on the dealership side. And at the same time, as you imagine, in the financial world, they have their own set of data science teams and they have their own statisticians. So we had to put some more layers behind our data. And so Anil came in and did a wonderful job and created our data science team, which consists of mostly a data science, PhD statisticians, just a group of very, very bright. I sometimes call them smarty pants. Some very smart people. I walk in their office and they have a whiteboard and it looks like hieroglyphics with all this different formulas that they're doing. Just a great group, and we continue to add to our team. And a big piece of that is we're not just a book company anymore. Our data science team helps us with our forecasted values to be more precise. Many new data enhancements that we've rolled out. And then more recently, we've been working with a lot of the manufacturers, and we do consulting and custom studies. Those things can be maybe the EV market. We've got a lot of new players, new manufacturers coming out. They expect to be doing a lot of leasing on these higher cost vehicles, and they need to know what they expect these vehicles to be worth in the future. They have their own predictions, but they come to Black Book to have a totally independent, unbiased prediction. And it's not just on the EV. We have manufacturers that we may do a recession study. What if we have a recession? What does Black Book expect? Or maybe they're coming out with a brand new vehicle and they want Black Book to give them advice on content and how it should be built, how it compares to their competitors. So it's really an open book with having our data science team.
Let's talk for a few minutes about used car prices, both, where they are today, but almost, and if not more importantly, we went through a period, and I think we're kind of out of it now, but where used car prices were absolutely going through the roof. Can you share a little bit, kind of looking back on, what were some of the real causes of that? And then in line with that, what are the trends that we're seeing now as far as used car prices versus new car prices?
So we've had a historical market the past 3 years. If you want to look in the past first, traditionally, used car prices are going to depreciate around 13.5% year over year. So that's roughly, say, 1%, 1.5% per month. That's what we've always typically seen. There's some years it may be 17% or 16% or 12%, but usually about 13.5 is what you expect. We had the pandemic that occurred. They plummeted shortly, and then, of course, they exploded. 2020, year over year depreciation was only 2%. And so that was just unheard of. Then we got into 2021. There was not any depreciation. There were appreciation of 28.7%. So unheard of. Appreciation of almost 30% on used cars 2 to 6 year old vehicles. Now we get into last year, we had a large depreciation, but you got to keep in mind we were coming off of historical highs, so there still wasn't really much if you look at it, coming off of a high. But 2022 year over year, it was 22.9% year over year depreciation. Going into 2023, we're getting towards the end. We're expecting about 18% year over year depreciation, which is still a high above that 13.5% that we typically would see, but we're still coming off historical highs. As far as what caused this, mostly it's going to go straight to supply and demand and inventory. When we had lockdowns, people, and had money from all this government money pumped into the economy, people were ready to buy cars and ready to go places. The problem was, there weren't many cars out there for them to purchase. Manufacturers canceled their chip purchases, and then there was a big chip shortage, which led to no new cars available, no new inventory. You also had rental car companies defleet because no one was traveling. And so basically, it all came down to inventory levels, and the demand was high and supply was low. Used cars, there's not a used car factory. Where used cars come from are a couple of main sources. One is going to be trade-ins. So when you go to purchase a new car, you trade in your car and there's a used car for someone else to purchase. Well, there were no new cars, therefore no trade-ins. A second major source are going to be rental cars. So a lot of times rental cars defleet. That floods the market with 3-year-old vehicles. Well, they already defleeted, so there were no rental cars in the market. That's another source of inventory. And then going into the future as well, I'm sorry, then you also have lease returns. That's another big major source. So leases are basically calculated trade-ins that are going to come back, typically say 36 months from lease origination. Well, the values were so high compared to the residuals that were forecasted on these leases, the customers opt to purchase the vehicle. And a lot of times they would purchase it, their lease, and flip it. So there were no used cars.
So let me ask a question. When there's still a lot of debate going on in the market, we're seeing different companies are adopting different policies as far as working from home. You're working from home right now. I'm working from home right now. I see that while some companies may, I think, try to move to a pure at work policy, in the office policy, I think that as certainly the younger generation likes this flexibility. So I think there's going to be more of a hybrid type model that we see out there. Do you see that impacting car ownership? More and more people working from home and maybe questioning, why do I need to have a car sitting in my driveway 3 days a week?
I really don't see it impacting. This is just my opinion. People still Americans love their cars. They want to go on vacation. It's just part of our society and our culture. If you are going to have those urban, probably millennial, younger generation, they may not already have a car anyway, and they probably don't leave a 3-mile radius, and they're going to be using the Ubers. But in the suburbs and more rural areas, they're going to have their cars.
So in line with that, I was reading about trends around car ownership, and you mentioned Uber, so you got rideshare vehicles, Lyft and Uber. We have subscription ownership companies like Zipcar, where people basically are renting the car for a day or a couple of hours even. And then the latest trend I was reading about is called shared ownership, where multiple customers actually are making payments on the same car. And when I think about car values, and I think about, one of the most obvious is the high mileage, right? The more mileage, the less value the car is. But I was just curious whether you guys have a way that you're able to detect the actual ownership model of a vehicle. And is there some impact that if you have a car that's being driven by 5 different people during the course of a year, that's going to result in a more rapid depreciation?
So we do have a way to notate the vehicle itself. We've moved into what we call a VIN specific value. So back in the 1950s, 60s, 70s, 80s, there was a black book pre-internet. And if it's a 3-year-old RAV4 with 30,000 miles, XLE with leather seats, that's the value. And that's the value for every one of them in the US based on a guidebook. But we've moved, like I mentioned, to a VIN specific value. And there's a couple things that we're doing, but mostly in particular, we look at the history of that particular vehicle. So we're not just looking at, say, that 2-year-old RAV4 with 30,000 miles. We're looking at Rich's RAV4 sitting in his driveway. And we know that Rich's vehicle was certified pre-owned, 2 months ago. And we know that he's only the second owner, he's only the second owner of the vehicle. We know that his perfect service records, no incidents. So that's going to add value to the vehicle. And a lot of this derives from the consumer with, say, Carfax reports and vehicle history reports, where you pay up more if you have a super clean car. Now, we're not looking at, say, is it a ride share or if it's not a ride share, but if it is a ride share, it's going to be reflected in the mileage. And so when you pass us in that mileage, we'll be able to, of course, adjust for those higher mileage vehicles. And we will adjust the value for number of owners. But more in particular, is going to be major incidents like wrecks, salvage title, frame damage reported at auction. So that's kind of what's going on at Black Book to address some of those.
Yeah, it will be interesting, though, if we do move to a model where multiple people are making payments and using the same car, right? That how you detect that. And I just got to believe that. I mean, people have very different driving behavior.
I think it would affect insurance too.
Yeah.
How does an insurance company tackle that? If you've got one person that's 20 years old that's had 2 speeding tickets versus the other owner is 26 and perfect driving record, how do you charge for a rate? How do you know when? I think there's a lot of questions around that.
Yeah, and even reporting to the credit bureaus. Let's kind of talk about a topic that you can't avoid nowadays with in the auto industry, and that's electric vehicles. So we're seeing obviously more and more regulations mandating were proposing the elimination of the production of combustion engines by a certain year, some as early as 2030. Many agree we are far off from having the infrastructure that can support a rapidly growing presence of all electric vehicles. Case in point, I came across this. According to a JD Power survey, customer satisfaction with public electric vehicle charging infrastructures continues to decline. Satisfaction with public level 2 charging decreased 16 points year over year from 633 to 617 on a 1,000 point scale. So it wasn't that high to begin with. Customer satisfaction with direct current fast chargers dropped even more, declining from 674 to 654 in the last year. And then conclusion is that a lack of adequate public charging infrastructure could slow consumer adoption of EVs. Nevertheless, the handwriting is on the wall, and it's hard to envision any reversal of this trend. Thinking about car values, at what point do you predict we'll start seeing a fall off in the value of combustion engines, cars, and how substantial could that be?
So I don't see that happening anytime soon. Gas vehicles, diesel vehicles, they're not going anywhere anytime soon. If you watch the Super Bowl ads, you would think that everybody 6 months from now are going to be driving a EV and they're going to be plugged into it. Just like you mentioned, the infrastructure is not there. Consumer appetite is not quite there either. I looked at some of our data, and let me just pause. What if everybody today said, hey, I'm going to move electric. I'm going to go buy an electric car today. I'm getting rid of it. Well, the inventory's not there, one. As of new cars for sale, I think as of yesterday, it was around 2.3 million new cars listed in the market for sale. Out of that 2.3 million, there was only around 177,000 EVs available. So there's not even there if you wanted to. And then on the used side, it's around 2.2 million used cars listed out there for sale. There's only 153,000 of them out there. And like you mentioned, the infrastructure is not there. The charging stations not working, having to wait for them to work. I saw an article about Ford CEO tried to do a road trip in an F-150 Lightning, and he was awakened by how long it took him to get from, I want to say, California to Las Vegas. But then you also got to think about, when I talk about infrastructure, there's other things that other information I've looked at and found are certain things about the vehicles. One, I don't think people realize how heavy they are. They're much heavier than your ICE vehicles. So with that said, think about a bridge. Maybe it was built 60 years ago. I'm sorry, 160 years ago. And you've got these unbelievably heavy vehicles on these bridges. The infrastructure is not even there on some of the roads for these vehicles. Even towing, if you've got a car hauler, they can't carry as much of a load as they can of the used car light trucks, but your typical used car light trucks. Then you look at power grids. Okay, you've got a heat wave going on right now. You've got places in California and Ohio that are, they can't keep up with just running the air conditioners. How do they expect that to occur if everybody's got their vehicles charged in? And then even talking on the charging stations, there's also issues that have been reported with theft. Just like you would have people that would steal the copper out of your air conditioner, thieves are understanding there's precious minerals inside these chargers to go in there and steal those and steal the insides of them. And then another thing that's probably not talked about as much is going to be, what happens when there's an accident and these vehicles catch on fire. Typically, one fire truck is going to be able to take out a combustion engine vehicle fire. They're taking 6 fire trucks out there and still can't get it out. Or if they think that they've got the fire controlled, it's coming back to life. So it's just not there yet. Trying to get there, but I think there's also some consumer demand on there with, say, the towing piece. If you buy a pickup truck, you're going to want to likely tow a camper. You're going to want to tow a boat or a motorcycle or some of your toys. Well, what people may not realize is that deeply takes away the range with these heavy loads. You may get half the range. So there's just a lot out there right now.
There's a lot left to do to make it really something we can shift to. But that said, I still envision a day where, and the question for you is, there's that tipping point, right, where people I could see being concerned and saying, I'm going to go out and buy a car today. I'm getting closer and closer to these mandates, these dates. So I really want a combustion engine, but maybe I should lease it instead of purchasing it, because I'm probably gonna have to get rid of it maybe and shift to a EV sooner rather than later, if that makes sense.
One of the most successful car manufacturers out there is Toyota, of course. And I've noticed that they've been less aggressive on the EV push. They're more leaning on hybrid. They're not jumping all in saying, hey, we're going to convert all of our vehicles to electric by X year. So I think there's still more work to be done. I mean, Me personally, the hybrids is the way to go, but I've also seen that they're looking at a hydrogen engine development, which could be sustainable. So I think those are just things to watch. I think as a consumer, you've got to be a little bit concerned. What if, what you buy today becomes obsolete in 2 years?
Yeah, I was reading that there's some predictions in the auto industry going on right now that we're actually getting ready to face a potential oversupply due to robust production married with purchasing challenges due to higher average car prices, higher interest rates. Many predicting a price war on the horizon, and some saying it could be significant. You know, it's interesting. I live not that far from a Tesla dealership. We know that Tesla recently reduced price, I think like 10 grand on two of its models. I feel sorry for people that bought those cars a year ago. But it's interesting. I live not too far from a Tesla dealership, and there seems to be this. I'll see these trucks pull up with all these Teslas not too far from where I live, and there's like this overflow lot of Tesla cars, and there must be 200 cars in that lot that are 3 miles from the Tesla dealership, which has another 100 cars in the lot. So, what's your feeling about, is there oversupply coming, and what's that going to do to prices?
Well, just like you mentioned, they slashed prices overnight, and then we saw the same thing with the Ford, Ford F-150 Lightning, almost the same exact thing. So that does impact a lot of different things. Even as a valuation guide, it impacts our forecast on the values. It impacts, we have to make changes almost overnight to these values when this occurs. The EVs, if you think about it, it's just a battery and wheels. There's not a transmission per se. There's not a engine. So they're easy to build. There's not that many parts to it.
Yeah.
So I think that's part of it too. It's easier and quicker to build. I think you may see in the dealer world, they may have a tougher time selling them, pitching them, and may lean towards putting the customer into an ICE vehicle. And then we talk about, if you're a consumer as well and you like to go on a road trip, you're probably not going to want to have to do the charging piece if you have a decent traveler. Now, I'm for EVs. I think they're a great product. I think you just let the market determine what people want, and eventually that's where it'll go. It's all going to be determined on consumer demand.
Right, right. So, not around maybe some of the trends that were going on in the auto industry today. I read a report. Wanted to get your thoughts on it. It was back from 2020, and it was published by the Insurance Auto Auction Company, and it talked about negative equity in cars. And it highlighted several factors. And once again, this is back from April 2020, but I think some of the things probably are still there. It said that they estimate that nearly 5 million cars are declared a total loss each year, and 60 to 70% of those total vehicles still have loans, and therefore they face a negative equity situation. It said it highlighted several factors that are combining to create negative equity: the increasing cost of new vehicles and the ever-growing consumer demand for high-value vehicles such as EVs, the elevated level of depreciation with new vehicles, and this is back once again in 2020, losing up to 20% of their value in the first year alone. And as we talked about earlier, the increasing longer time on loan terms, many 84 months, that often outlive the average vehicle warranty. And of course, it says today's environment of rising cost of borrowing. So all those things, even though this article is from April 2020, I could change and call it August 2023, it seems. So can you talk a little bit about this concept of negative equity, and how does that maybe impact some of the trending data that you're seeing and whatnot?
Yeah. So, I think part of the negative equity trend, you need to look at long term. I remember whenever I was doing loans back in 2006, 2005, 60 months was kind of a stretch back then.
Yeah.
Now we're seeing 72, 84 months. So when you have that long amortization period, that balance takes a good while to get into a position of equity. So that's one piece of the equation there. Okay. Another piece is going to be the timing of that loan. When was that loan booked? You can look at our Black Book Index. You can see it online if you go to blackbook.com and Market Insights. And we update the index publicly every month. But if you look at that, it was steady pretty much from, say, July 2011 all the way to, say, until the beginning of the pandemic. Okay. So you had that problem there because of the loan terms and the balance coming down so much slower than normal. That's one piece of it. But another thing that's very important is, when did you book that loan? Okay. If you booked it in, say, April of 2020, we saw the values come down very, very sharply for a brief period. So that same car was actually worth a whole lot more a year later, year and a half later, as the values appreciated like they did
Right.
at that point. Now, if you book that loan at the peak, those, if you have a portfolio, those are ones you really need to focus on, and there's multiple ways to do that, but basically keeping a pulse on that equity position and working with those customers. If it's loan amendments, if it's rewrites, whatever you got to do, you don't want to take that loss. But I think that's the main vehicles you really want to focus. I'd probably say anything booked in between January, I'd say probably October 21 until probably October 22. That's when you're going to see probably your highest negative equity positions. But I will mention one piece about that too. At the same time, it was a new car. They were bringing in a trade-in, and that trade-in was bringing in a lot of money too. So that kind of helped offset some of this.
Interesting. So you mentioned at the beginning that we're integrated partners with you guys at GDS Link. Thinking about the pandemic going back a little bit and wondering whether you all saw an increase in the use of the data and your solutions in the underwriting process. Did you see some spikes during the pandemic, and have they continued post-pandemic?
So one thing that we did see, of course, is the further digitization of the lending across many verticals, trying to do basically almost like a Carvana. You can go online, apply, submit your information, and have a car delivered to your door. And trying to make that not going to the dealership, those types of things accelerate. What we saw some with is some of our way our data is being used, and then some of the product and enhancements that we put out. Some things are pretty simple, but whenever you go to purchase a vehicle, your trade-in is a big piece of that equation. How much are you going to get for your trade-in? So customers want to know quickly, what that is, what that number will be. And when you go online, they want an accurate trade-in. So one thing we did is we work with the DMVs, and we have a license plate to VIN decoder. So instead of having to put in your full 17-digit VIN number, somebody can be online and just type in their license plate and their state, and basically it brings back a VIN for us to give them a correct trade-in value. So we saw increased integrations there. And then more recently, BlackBook has worked with CAR, which is an auction group, and Backlot Cars for what we call a guaranteed offer. And with guaranteed offer, you go in, you put in your license plate or your VIN number, and you ask specific questions about your vehicle. It's usually 3 or 4 questions, like do you have all your key fobs? Do you have any scratches? Just a few specific questions. And then in a matter, we try to make this process less than 5 minutes, and you receive a competitive offer for your vehicle. And that could be, some people are purchasing the vehicles to have inventory when we were low on inventory, but it gives that consumer a guaranteed number they can walk into a dealership with. We partnered with Car Bravo, which is a platform from GM, and it's taken off. It's slowly growing because it's trying to streamline that process. They don't want to go to one website and get a trade-in value, then go to another, and then come into a dealership and it's totally different than what they had online. So it's just more transparency and making the process just faster for the consumer, because that's what they're demanding.
Does that product have a specific name?
It's through right now through a platform called Car Bravo.
Okay.
And it's basically GM's kind of
Online marketplace.
Yeah, for them to, it's neat though, because they're not only doing GM vehicles, they're doing all kinds of different vehicles outside of their vehicle set. So it's and it's really cool. So if the dealer signed up for that service and you get that guaranteed offer, the dealer has kind of dibs first on that. So if they want to honor that guaranteed offer, they can. If they don't want to, that's okay. The process goes along. The customer doesn't even know it. Then the next day, Backlot Cars comes, picks up the car, and cuts a check to the dealer, and then takes that vehicle to the auction and sells it. And there's other offers out there with some of our competitors, but the difference is ours is much more competitive. It's not a low ball offer that you may see.
So, one of the things that we promote at GDS is the use of our software Medelica across the full credit lifecycle, originations, account monitoring, collections. I think you touched on it a little bit, but maybe get a little more deep in how your data might be used for portfolio valuations and also maybe in collections.
Traditionally, most financial institutions would just look at a vehicle value at loan application to determine an advance amount. And then they may not ever look at it again until it's deep, deep state collections, or even at what we call remarketing, where they have to liquidate the asset at the auction. So that was kind of your traditional touch points only. So now we're over the years, as you know, we have much more data centric teams across the US. We're being plugged in multiple different what we call use cases. So pre-origination, before they even do the application, risk teams will develop models or scorecards. And what they look at is the historical and or forecasted depreciation patterns of different vehicles. So just like you have a 850 credit score, maybe a grade A, maybe a 620 as a C, a similar concept, but instead of credit risk rating, it's collateral risk rating. So they may look at, say, a Toyota Tacoma that holds its value quite well and grade that vehicle as a grade A or grade 1. And then on the other side, there could be a Dodge Durango that drops like a rock, that they put that as a C grade vehicle. So they'll build these out behind the scenes and may determine to advance higher LTVs or go different terms based on the riskiness of the vehicle. But then once they book the loan and it's an active loan in the portfolio and it's a funded loan, every month or every quarter, they'll go in and refresh the values on the portfolio. And then they take that output data and use it for internal reporting to understand exposures, for their loss forecasting, and then also in their collections. So if you got your 30, 60-day late accounts, if one account is upside down $10,000 versus one is positive equity of $5,000, it needs to be collected differently. And they use that data to determine different buckets for collections. And then, of course, in the remarketing piece, they look at the black book values and determine how much they expect to set as a floor at the auctions if they can liquidate the vehicle. But then even before the loan application, there's also where used in marketing. They'll take some of that output data and look at positive equity customers. And they may offer a restructure or even a cash out refi. And that's kind of where we plug in all throughout the loan life cycle.
Great. Well, I appreciate that. So we've touched on a lot, and keep an eye on the time here. Going to give you an opportunity to share if there's any additional trends that you've seen that you think would be interesting to our audience, to our listeners today that we haven't touched on before I wrap up. Anything, Brian, that you'd like to touch on?
So as far as some trends that we're seeing here lately, I think I mentioned the portfolio valuations have picked up more so as there's been concerns about the market. But we rolled out a new product that's actually this week called Pulse. And it's made up of retail listings data. And what that is every night, Black Book scrubs every vehicle listed for sale in the US and Canada. And we're basically putting out trends of real-time information of what's going on in the market. We're putting out there, of course, how many units are available, where are they at, how long are they taking to turn as far as sell, what's the day's supply on the vehicles, are they CPO, are they EVs, all types of information just direct on the market. So it's very powerful. A lot of it's tailored towards our manufacturer clients, where they need to look at different things as far as how their CPO program's moving, but also some of our remarketing clients, where they look at it and say, hey, where do we need to send these vehicles? There's a high supply of EVs in Northern California. Looks like there's a low supply in Texas. Let's send them there. Then we also have floor plan companies, which are basically lenders that lend money to dealers to purchase vehicles to put on their lots and sell to the consumer.
Right.
And so a lot of times they can check and double check to make sure that the money they've lent out on these different vehicles, these vehicles are actually live and for sale, or these vehicles have actually sold or not. So it's really some cool stuff. It's definitely different than your traditional Black Book data. But some of the trends is kind of pulling back the curtains on some of the things that we have internally and putting it out there to the market to help our clients.
And once again, that was called Pulse?
Yep, Pulse.
Thanks for sharing that. Well, this is Rich Alterman, and we've been syncing up with Brian Clegg, Senior Lender Solutions Manager at Black Book. Thank you, Brian, for joining me today and sharing some background on Black Book and trends in the auto industry. As part of the post of this podcast, we will provide a link to Black Book's weekly market insight updates, which comes out every Tuesday. So click on that link. You can sign up and get that trends report on a weekly basis. Hope you all enjoyed this podcast, and please stay connected with GDS Link and the Lending Link to listen to future podcasts and catch up on the ones you've missed. Thank you, and make it a great day. Thanks for listening. If you've enjoyed today's episode, please be sure to subscribe on Apple, Spotify, Google, or wherever you listen to your podcasts. And be sure to leave us a review. Follow us on LinkedIn and connect with us on Twitter at GDS Link. That's at GDSLINK. Have a question for the show or have a specific topic you want us to cover? Hit the link in the description to drop us a note. Thank you for lending us part of your day. Make it a great one.